Corporate finance, one of the most important sections in the CFA Level 1 program curriculum. We have two study sessions, Corporate Finance 1 and Corporate Finance 2. Topic level learning outcomes. The candidate should be able to evaluate a company's corporate governance, to analyze capital budgeting problems, to estimate a company's cost of capital, to evaluate a company's operating and financial leverage, and its working capital management. Some academic studies have shown that well-governed companies may perform better in financial terms, increasingly investment approaches, and consider environmental, social, and governance factors, known as ESG, are being adopted in addition to good governance practices. Management decisions regarding investment and financing also play a central role in the corporate profitability and performance. To remain in business as a going concern and to increase shareholders' value over time, management must consistently identify and invest in profitable long-term capital projects relative to cost of capital or financing, and make optimal use of leverage and working capital in day-to-day operations. So, Corporate Finance Study Section 10, Corporate Finance 1. This study session provides an introduction to corporate governance in investing and financing decisions. An overview of corporate governance is presented along with a framework for understanding and analyzing corporate governance and shareholder management. The growing impact of environmental and social considerations in investing is also highlighted. Capital budgeting and the assessment of capital investments are covered next. The section ends with practical techniques to estimate a company's or project's capital cost of capital. Reading assignments, reading 33, corporate governance and ESG, an introduction. Reading 34, capital budgeting. Reading 35, cost of capital. So, reading 33. Corporate governance and ESG, an introduction. Learning outcomes. A candidate should be able to describe corporate governance, describe a company's stakeholder groups and compare interests of stakeholder groups, describe principal agents and other relationships in corporate governance and the conflicts that may arise in these relationships, describe shareholder management, describe mechanisms to manage shareholder relationships and mitigate associated risk. Describe functions and responsibilities of a company's board of directors and its committees. Describe market and non-market factors that can affect shareholders' relationship and corporate governance. Identify potential risk of poor corporate governance and stakeholder management, and identify benefits from effective corporate governance and shareholder management. Describe factors relevant to the analysis of corporate governance and shareholder management. Describe environmental and social considerations in investment analysis. Describe how environmental, social, and governance factors may be used in investment analysis. Introduction. Weak corporate governance is a common dread found in many company failures. A lack of proper oversight can be by the board of directors, inadequate protection of minority shareholders, and incentives at companies that promote excessive risk-taking are just a few of the examples that can be problematic for a company. Poor corporate governance practices result in several high-profile accounting scandals and corporate bankruptcies over the past scandal decade, and have been cited as significantly contributing to the 2008-9 global financial crisis. In response to these company failures, regulations have been introduced to promote stronger governance practices and protect financial markets and investors. Academic policy makers and other groups have published numerous works discussing the benefits of good corporate governance and identifying core corporate governance principles believed to be essential to ensuring sound capital markets and the stability of the financial system. The investment community had also demonstrated a greater appreciation for the importance of good corporate governance. Assessment of a company's corporate governance systems, including considerations of conflict of interest and transparency of operations, has increasingly become an essential factor in the investment decision-making process. Additionally, investors may become more attentive to environmental and social issues relating to the company's operations. Collectively, these areas are referred to as an environment, social, and governance, ESG, environmental, social, and governance. Section 2 of this reading provides oversight of corporate governance, including the underlying principles and theories. Section 3 discusses various stakeholders of a company and conflicts of interest that exist among stakeholders. Section 4 describes stakeholder management, reflecting how companies manage their relationships with stakeholders. Section 5 focuses on the role of the board of directors and its committee on oversight of the company. Section 6 explores certain key factors that affects the corporate governance. Section 7 highlights the risk and benefit that underlie a governance structure. Section 8 provides an overview of corporate governance issues relevant for investment professionals. Finally, Section 9 discusses the growing effects of environmental and social considerations in the investment process. Corporate governance overview. Corporate governance overview. In corporate governance, it could be defined as a system of internal controls and procedures by which individual companies are managed. It provides a framework that defines the rights, roles, and responsibilities of various groups within an organization. At its core, corporate governance is an arrangement of checks, balances, and incentives a company needs to in order to minimize and manage the conflicting interests between insiders and external share owners. Corporate governance practices differs among countries and jurisdictions, and even within countries, different corporate governance systems may coexist. A corporate governance system systems adopted to most of the world typically reflects the influence of either shareholders' theory or stakeholder theory in a varying extent, as well as historical, cultural, legal, political, and other influences specific to the region. Shareholder theory takes the view that the most important responsibility of a company's managers is to maximize shareholder returns. Stakeholder theory broadens a company's focus beyond the interests of only the stakeholders of its customers, suppliers, employees, and others who have an interest in the company. The approach to corporate governance is in a given country is typically placed greater emphasis on the two theories, but can also exhibit a combination of the two. Notwithstanding the system of corporate governance used, nearly all companies depend on contributions from a number of stakeholders. For long-term success, the company's strategy is set by the board of directors, which also oversees management. In turn, the company's strategy is executed by its managers. Financial capital to fund the company's activities and operations is supplied by the shareholders, creditors, and suppliers. Human capital is provided by employees, and demand for goods and services comes from customers. Other stakeholders include governments and regulators, which seek to protect the interests and well-being of their citizens. Certain external factors, such as legal environment and the competition, after the way a company operates and the relationship among its stakeholders. Two report issued during the 1990s and our Capital Report and the Principles of Corporate Governance were practically influencing and shaping the global corporate governance landscape. In 1991, the Committee of Financial Aspects of Corporate Governance was established in the United Kingdom by the Financial Reporting Council, the London Stock Exchange, and the accountancy profession to examine corporate governance. In the following year, the report of committee, commonly referred to as the Cadbury Report, after its chairman, defined corporate governance simply as the system by which companies are directed and controlled. The report focuses on the responsibilities of a company's board of directors, shareholders, and auditors, with shareholders implicitly identified as the primary stakeholders. In 1999, the Organization of Economic Cooperation and Development, OECD, produced the Principles of Corporate Governance, which expanded the scope of corporate governance to consider the interests of other stakeholders, notably employees, creditors, and suppliers. According to the OECD, corporate governance which was revised in 2004 and again in 2015, also discusses potential positive outcomes of good corporate governance practices and includes standards and guidances designed to evaluate and improve the corporate governance framework throughout the world. There is evidence that some movement toward global convergence of corporate governance systems is underway. One trend is an increasing acceptance and adoption of corporate governance regulations with similar principles with one jurisdiction. For example, one number of countries implemented regulations similar to those of the U.S. Sarbanes-Oxley Act in 2002 in response to corporate accounting scandals in the early 2000s. Although the regulations are not identical, they share the same objectives and improving internal controls and restoring investor confidence in financial disclosures. Another trend in incentives by international agencies to build greater consensus on important corporate governance principles. The principle of corporate governance, for example, has been ratified by more than 30 member countries, representing a broad range of corporate governance models. The principles of corporate governance do not mandate or even promote the adoption of a single corporate governance regime. Rather, the principles were designed to serve the framework that can be adopted by a number of corporate governance systems. Company stakeholders, a corporate governance system is like likely to be influenced by several stakeholding group. Those groups are not necessarily share similar goals to needs. In fact, the interests of any one group may conflict with the interests of another group. The very influences of these groups are important considerations for investment professionals when analyzing a corporate governance system. This section provides an overview of a corporation's primary stakeholders group, followed by a discussion of principals, agents, considerations. Stakeholder groups. The primary stakeholder group consists of the shareholders, creditors, managers, and other employees. Board of directors, customers, suppliers, and government/regulators. Affecting individual and community. These interests of each of these groups are discussed in the following section. Shareholders. Shareholders own the shares of stock in a corporation and are entitled to the certain rights, such as the right to receive dividends and to vote on certain corporate issues. In terms of capital structure, shareholders are the most junior class of capital providers. In case of a company bankruptcy, shareholders receive proceeds only after all creditors' claims are paid. Shareholders' interests are therefore typically focused on growth and corporate profitability that minimize the value of a company's equity. As the company grows in size and its operations and structure becomes more complex, most individual shareholders have little involvement in the company's activities. Shareholders maintain control over the company through the power of elect the board of directors and vote for specific resolutions. The board of directors is expected to represent the shareholders, protecting their interests, appointing senior management, providing strategic direction, and monitoring company and management performances. In publicly traded companies, to have dispersed ownership, the voting power is generally meeting in distributed amount of among a large number of shareholders. But in some companies, a particular shareholder or block of shares may hold a percentage of shares that gives them sufficient voting power to control the election and board of directors and the influence of approval or brokerage of a company's resolutions. These shareholders are known as controlling shareholders. In contrast, non-controlling shareholders or minority shareholders hold a much smaller proportion of a company's outstanding shares, resulting in a more limited ability to exercise control in voting activities. Creditors. Creditors, most commonly bondholders, are banks, and the company's lenders and the providers of debt financing. Creditors do not hold voting power. Typically have limited influence over a company's operations. Creditors may protect themselves and exert some control over a company being used. Covenants which restrict activities of the borrower in turn of capital provide the creditors expected to receive interest and principal payment. These payments are predetermined from the term of the debt contract and are typically not contingent on the company's performance. Creditors usually do not participate in a company's superior performance beyond receiving promised interest and principal payments. Managers and employees, senior executives, and other high-level managers are normally compensated through salary, bonuses, equity-based remuneration or compensation, and certain prerequisites. As a result, managers may be motivated to maximize the value of their total remuneration while also protecting their employees' position. Lower-level employees normally seek to fair renewment, good working conditions across the promoted career development opportunities, training and development, job security, and safe and healthy work environment. As with the shareholders and creditors, managers and the employees have a significant interest in the company's viability. Managers and employees tend to benefit if the company performs well and are among the most adversely affected shareholders and the company's financial position weakens. Despite some similarities, the interests of managers and employees of stakeholders can conflict. For example, a company may be presented with a takeover offer that is attractive to the shareholders, but would jeopardize the interests of managers in preserving their employee at the company. Board of Directors. The company's board of directors is elected by shareholders to protect shareholders' interests, provide strategic direction, and monitor company and management performance. A board is typically structured as one tier or two-tier. One-tier structure consists of single board of directors composed of executives and non-executive directors. Executive directors are employees, typically senior managers of a company. Non-executive directors are not employees of a company. Countries in which one-tier board are common include United States, the UK, India. Two-tier structure consists of two separate bases, the superior board and the superior board, which is primarily composed of non-executive directors, and a management executive board, which is composed of executive directors. The supervisory board and management board, two-tier boards, are common across countries as Germany, the Netherlands, Finland, and China. In this reading, unless specified otherwise, the term board refers to the single board directors, and one-tier structures, and the supervisory board in a two-tier structure. Directors, both internal and external, are typically experienced individuals who while maintaining a good reputation in the business and community. Directors can also typically concerned with their expectations to liability to breach of duty. Directors can mitigate the exposure by exercising appropriate levels of control over the company's operations and its management. And company's board of directors is discussed in more detail in section 5 of this reading. Customers, suppliers, principal agent and relationship to corporate governance. The principal agent relationship: when a principal hires an agent to perform a particular task or service, the participal agent relationship involves shareholders management. Because interests among shareholder groups differ, companies often adapt mechanisms to be more efficient manage holders' relationship. Shareholder management involves identifying, prioritizing, and understanding the interests of stakeholder groups, and on the basis managing the company's relationship with these groups. Overview of shareholder management: effective communication and active engagement with various shareholders. With various stakeholders. On the basis of stakeholder management, although the practices underlying stakeholder and management may vary, companies typically seek to balance the interests of their various stakeholders to thus limit the effect of conflicts. To help balance these interests, corporate governance and stakeholder management frameworks reflect a legal, contractual, and organizational and government infrastructure that defines the rights, responsibilities, and powers of each group. The legal infrastructure defines the framework for rights established by law and availability or ease of legal resources for any violation of the rights. The contractual infrastructure is shaped by the contractual arrangements either entered into by the company and its stakeholders, and that helps define and secure the right of both parties. The organizational infrastructure refers to internal system, governance, procedures, and practice adopted and controlled by the company in managing its stakeholder relationship. Lastly, the governmental infrastructure refers to regulations imposed on companies. The corporate governance system is such countries like France, Germany, and Japan focus broadly on the stakeholders relative more to the stakeholder-driven Anglo-American system. Globally, there are a growing movement among regulators and practitioners to make effective balance the interests of all stakeholders. For instance, the Companies Act in 2006 in the UK introduced enlightened shareholder value, which requires directors to consider the interests of all stakeholders, not just the shareholders. Several regulators, such as the United Kingdom and Japan, have adopted stewardship codes that encourages more active engagement of institutional investor with companies. Mechanisms of stakeholder management. Stakeholder management and governance practice attempt to manage the interests of all stakeholders. As mentioned earlier, a prescribed or standard set of rights and projections practices does not exist across all companies, and the principles vary across countries and jurisdictions. Still, there are some common control elements and governance mechanisms among companies. General meetings, corporate law grants shareholders certain powers and controls. The participation of shareholders in general meetings, also known as general assemblies, and the exercise of their voting rights are among the most influential tools available. General meeting enables shareholders to participate in discussing and to vote in majority vote on major corporate matters and transactions, and are not delegated to the board of directors. Companies are ordinarily required to hold annual general meetings, or AGM, within a certain period following the end of the fiscal year. The main purpose of these meetings is to present shareholders with the annual audited financial statements of the company, provide an overview of the company's performance and activities, and address shareholder questions. Shareholders are elected to directors at the AGM, and in some countries may require to approve the financial statement, discharge directors of their duties, appoint external auditors, or vote on remuneration of the company or shareholder throughout the year. Then significant resolutions requiring shareholder approval and proposed. These resolutions might relate to proposed material corporate changes, such as amendments to the company's bylaws or rights attached to the class of shares, mergers and acquisitions, and the sales of significant corporate assets or businesses. All shareholders typically have the right to attend, speak at, and vote on general meetings regulating particularly corporate law specified conditions for inviting shareholders to general meetings and circulating information to shareholders. Thus, conditions vary across regulations, but generally aims to ensure the participation of a large number of stakeholders in general meetings without imposing exercise restrictions on the ability of the company to hold meetings. By engaging in general meetings, the shareholders can exercise their voting rights on major corporate issues, and better monitor the performance of the board and senior management. General meetings and the underlying voting procedure are among the most widely adopted practices by companies in mitigating agency problems and their associated risk. Some resolutions, such as the approval of financial statements and the election of proxy voting, is the process that enables shareholders who are unable to attend a meeting authorize other individuals, for example, another shareholder or director, to vote on their behalf. Proxy voting is most common for investor participation in general meetings. Although most resolutions have most companies without controversy, sometimes minority shareholders attempt to strengthen their influence at companies through proxy voting. Several shareholders sometimes use the process of collectively voting for shares in favor of the opposition to a certain resolution. Cumulative voting enables each shareholder to accumulate and vote all his or her shares for a single candidate in an election involving more than one director. This voting process raises the likelihood that minority shareholders are represented by at least the one director on the board, but it may not be compatible with majority voting standards for director elections, in which share ownership is widely dispersed in terms of worldwide practices. The existence of cumulative voting varies from, for example, in Madrid, it is Madrid in Spain, but all allowed several countries such as Germany, Japan, Singapore, and Turkey. Minority shareholders are often granted rights to protect their interests in acquisition. For example, companies in European Union states are required to adopt sell-out rights. Such rights allow minority shareholders to have a vote out of merger, often to force a bidder, which would with more than 90% of targets voting rights to buy their shares at a fair price under the deal's approval. Board of directors mechanisms in companies with complex ownership structures and operations, it is impractical for shareholders to be involved in strategy formulating on day-to-day activities. Shareholders thus elect a board of directors to provide broad oversight to a company. The audit function is an integral component of the governance structure. The function represents the system, control, and policies and procedures in place to ensure the company's operating and financial records. Reporting and transparency. Shareholders have access to a range of financial and non-financial information concerning the company, typically through annual reports, proxy statements, disclosures on the company website and the investors' relation department, and other means of communication, e.g. social media. Such information is essential to shareholders to reduce the extent of information asymmetry between shareholders and managers, assess the performance of the company and of directors and managers, make informed decisions in valuing the company and deciding to purchase, sell, transfer, sell, and vote on key corporate matter or changes. Policies related to party transactions, the development and of implementation of policies for related party transactions and other conflicts of interest is an increasing commonly practice among companies. These policies established procedures for mitigating, managing, and discussing and disclosing such cases. Typically, directors and managers are required to disclose any actual or potential or direct or indirect conflicts of interest. Let me drink my cranberry juice. Strong like alcohol, but without the hangover. Drinking Kirkland Ocean Spray, yeah. Enumeration policies. Executive remuneration plans have gained significant attention in the investment world, with the primary goal of aligning the interests of manager with those of the shareholders. Say on pay. Given the role of remuneration plans on aligning the interest of executives with that of the shareholders, regulators and companies are increasingly seeking shareholder views to pay. The concept of say on pay enables stakeholders to vote on executive remuneration matters. Say on pay we first introduced in the United Kingdom in the early 2000s. On an example of 2003, the stakeholders of GlaxoSmithKline rejected the company's remuneration report because operations to the proposed executive pay was the first such rejections by shareholders of a large UK-based company. Contractual agreements with creditors. The right to creditors is established by law in accordance to contracts executed with the company. Laws vary by jurisdiction and uncommonly contain provisions to protect creditors' interests and provide legal resources. Employee law contracts. Employee rights are primarily secured through labor laws, which define the standard of employees' rights and responsibilities and cover such matters as labor hours, pensions and retirement plans, hiring and firing, and vacation and leaves. Most countries' employees have the right to create unions. Unions seek to influence certain matters affecting employees. The European Union company meeting specific size and geographic criteria are required to establish European Works Councils and are promised by employees. Yeah. I'll stop here and I'll continue into part 5 of Board of Directors and Committees in this continued reading. Goodbye. The Board of Directors and Committees. As discussed earlier in this reading, the Board of Directors is the central component of a company's governance structure. The board serves as a link between shareholders and managers and acts as the shareholders' monitoring tools within the company. As the relevance of corporate governance has grown within the investment field, the responsibilities of Board of Directors have also increased in importance. Composition of Board of Directors. The structure of composition of Board of Directors vary by company and geography. There is no single or optimal structure, and the number of directors may differ depending on the company's size, structure, and complexity of operations. Many corporate governance codes requires the board of directors includes a mix of expertise, backgrounds, and competence. Such qualifications may include specialized knowledge of a company's industry, as well as experience of certain functions such as strategy, finance, audit, risk management, human resource, or legal. Moreover, more companies seek age, gender, and racial diversity in board compositions. Boards with one-tier structures comprise a mix of executives and non-executive directors. Executive or internal directors are employed by the company and are typically members of the senior management. Non-executive or external directors provide objective decision-making, monitoring, and performance assessments. Additionally, non-executive directors can serve an important role in changing management and using past expertise in strategy and board issues. An independent director is a specific type of non-executive director that does not have a material relationship with the company with regard to employment, ownership, and remuneration. In two-tier structures, the supervisory and management boards are independent from each other. Regulators generally prohibit members and management boards from serving on the supervisory board or limit the number of individuals serving on both boards. Employees' representatives are typically elected by the company's employees and could make up half of the supervisory board in large companies. In many countries, the chief executive officer, CEO, is the chairperson role of the increasingly separated. In the U.S., many companies have historically have CEO duality, in which the CEO also serves as the chairperson of the board. Nevertheless, the percentage of companies separating the two roles, particularly in the U.S., has increased considerably in recent years. The appointment of the lead independent director is an alternative that some practices by board of companies without CEO duality. The lead independent director generally has an authority to request and oversee meetings of all independent directors. Duality is not applicable to two-tier structures that prohibits the members and management board from serving on supervisory boards. In these models, the chairperson of the supervisory board is typically external, and the CEO usually chairs the management board. Functions and responsibilities of the board, as mentioned earlier, a company's board of directors is elected by shareholders to act on behalf. In fulfilling their functions, directors have a responsibility to conduct the interests of all stakeholders. The duties of directors are mandated by law in many countries, but vary across jurisdictions. Two widely established elements of directors' responsibilities is the duty of care and the duty of loyalty. According to OECD's principles of corporate governance, duty of care requires board members to act on a fully informed basis, a good faith, with due diligence and care. The OECD further notes that duty of loyalty is the duty of the board members to act in the interests of the company and shareholders. The duty of loyalty should prevent individual board members from acting in their own interests or the interests of other individuals or groups at the expense of the company's and own shareholders. A board of directors does not typically engage in a company's day-to-day activities, rather the activities of delegated to management. The board guides and approves the company's strategic direction, taking into consideration the company's risk profile, and delegates the implementation of a company's strategy to senior management, oversees the execution of the strategy, and establishes milestones to monitor the process of reaching the objectives. The board also reviews corporate performance and determines relevant courses of action accordingly. And doing so, the board can monitor and evaluate management's performance and determine whether senior executive remuneration is aligned with the long-term interests of the company. The board is also responsible for selecting, appointing, and terminating the employment of senior management. One of the board's main responsibilities is to ensure leadership continues through succession planning for the CEO and other key executives. The board plays a central role in ensuring the effectiveness of the company's audit and credit control system. It sets the overall structure of the systems and oversees their implementation including oversight and financial reporting practices and the review of the financial statements for fairness and accuracy. The board also oversees reports by internal audits and audits the audit committee and external auditors, and proposes the follow-ups on remedial actions. The board has the ultimate responsibility to ensure the company adopts and implements proper corporate governance principles and complies with all applicable laws, applicable internal and external laws and regulations, including ethical standards. In addition, the board typically ensures that the company has an appropriate enterprise risk management system in place, whereby risks are identified, mitigated, and assessed. Managed appropriately, the board monitors the effectiveness of the systems through regular reviews and reports received from both management and the company's risk function. The board also has the responsibility to review any proposals for corporate transactions or charges, such as major capital acquisitions. divestitures, mergers, and acquisitions before they are referred to shareholders for approval if applicable. Board of Directors committees. A company's board of directors typically establishes committees that focus on specific functions, such as committees in turn provide recommendations that are reported to the board on a regular basis. Despite the delegation of responsibilities to committees, the overall board remains ultimately responsible to shareholders and is not discharged of the liabilities to shareholders. Although board committees may vary by organization, some of the most common committees are discussed in the following section. Audit Committee. The Audit Committee is perhaps the most common board committee among companies worldwide. The Audit Committee plays a role in overseeing the audit and control systems of the company to ensuring its effectiveness. In this regard, the committee monitors the financial reporting process, including the application of accounting policies, ensuring the integrity of financial statements, supervises the internal audit functions, and ensures its independence and competence, and presents an annual audit plan to the board and monitors its implementation by its internal audit functions. The Audit Committee is also responsible for recommending and the appointment of an independent external auditor and proposing the auditor's remuneration. Both internal and external auditors report their findings to the Audit Committee, which in turn proposes remedial action for highlighting issues or matters. Governance Committee. The primary role of Governance Committee is to ensure that a company adopts good corporate governance practices. In doing so, the committee develops and oversees the implementation of the corporate governance code, the charter of the board of and its committees, and the company's code of ethics and conflicts of interest policies. The governance committee reviews these policies on a regular basis and incorporate any regulatory requirements or relevant developments in the field. Most importantly, the committee monitors the implementation of the governance policies and standards, as well as the compliance with the applicable laws and regulations throughout the company. Remedial actions are recommended if any flows or breaches for laws or regulations are identified. In some companies, the governance committees may be responsible for overseeing an annual evaluation of the board to ensure that its structures and activities are aligned with the governance principles. Remuneration or compensation committees. The remuneration or compensation committee of the board specializes in remuneration matters. The committee develops the processes of remuneration policies for the directors, the key executives, and represents them for approval by the board or by shareholders. The committee may also be involved in handling the contracts of managers and directors, as well as in setting performance criteria and evaluating the performance of managers. The responsibilities of a remuneration committee may extend to establishing human resource policies for the company. When enumerating matters are involved in some companies, the enumeration committee also sets oversees the implementation of employee plan benefit plans, including insurance, pensions, severance benefits, and retirement plans. Nomination committee. The nomination committee identifies candidates who are qualified to serve as directors and recommends their nomination for election by shareholders. The committee also establishes the nomination procedures and policies, including the criteria for board directors, the search process, and the identification of qualified candidates for director positions, director independence, including what constitutes an independent director, is also a function of the nomination committee. Through these roles, the nomination committee can help ensure that the board's composition is well balanced and aligned to the company's governance principles. Risk committee. The risk committee assists the board in determining the risk policies, profile, and appetite of the company. According, the committee oversees establishing enterprise risk management plans and monitors their implementation. It also supervises the risk management functions in the company. Receives regular reports and reports on its findings and recommendation to the board. Investment committee. The investment committee is the board reviews material investment opportunities proposed by management and considers their viability for the company. Such opportunities may include large projects, acquisitions, and expansion plans, as well as divestitures or major asset disposals. The committee often changes when necessary. Management assumptions underlying investment prospects, monitors the performance of investments, and reports in findings to the board. The committee also is typically responsible for establishing and revising the investment strategy and policies of the company. The specific board committee discussed in previous section are the most commonly used, although the composition of the number of committees may vary depending on the jurisdiction or on company-specific factors. An audit committee, for instance, is a regulatory requirement in a large number of jurisdictions for banks and other financial institutions. A risk committee is strongly recommended by some regulators and required by others. In Brazil, the Central Bank of Brazil requires financial institutions to establish a enumeration committee. At the board level, some companies choose to combine two or more committees into one. For example, enumeration and remuneration or composition committee or an audit and risk committee. Companies may also find it valuable to establish committees with another specialization, such as a compliance committee or an ethics committee or human resource committee or a health/environmental safety committee. The composition of a board committee is nominally aligned with the scope of responsibilities. For instance, many regulators request that executive internal directors do not rule on matters underlying conflicts of interest or on matters requiring unbiased judgments. As such, a large number of rules, including those adopted by the London Stock Exchange and the New York Stock Exchange, requires that the audit and the compensation committees be composed of the independent directors only. Such stringent regulations, such as those of the Gulf Corporation Council, requires audit committees to be composed of external directors, the majority of which should be independent. Factors affecting shareholders and relationship and corporate governance. In this section explored, which weighs certain factors, both market and non-market related, can affect shareholders' relationship and corporate governance. For the section, market factors include those that relate to capital markets, whereas non-market factors do not. Market factors, this section focuses on the shareholder engages, shareholder activism, and competitive forces, all of which are influential market factors for a company. Shareholder engagement involves on companies' interactions with the shareholders, whereas shareholder activism describes the efforts by shareholders to create a change within a corporation or modify a corporation's behavior. Meanwhile, competitive dynamics can help align managerial interests and those of the stakeholder. Shareholders' engagement, the engagement of companies with shareholders, called shareholder engagement, has traditionally involved certain events, such as annual shareholder meetings and analyst costs, the scope of which was limited to financial and strategic matters. There is a growing trend, however, for greater engagement between companies and their shareholders beyond those venues and topics. Companies have increasingly recognized the benefit that frequent year-round engagement with shareholders can provide, such as building support against the short-term activist investors, countering negative recommendations from proxy advisory firms, and receiving greater support from management positions. Shareholder activism refers to strategies used by shareholders to attempt to compel a company to act in a desired manner. Although shareholders activism can focus on a range of issues, including those involving social political considerations, the primary motivations of activists shareholders is to increase shareholder value. Activist shareholders often pressure management through such tactics as initiating proxy battles, fights, proposing shareholder resolutions, and publicly raising awareness on issues of contention. Shareholders' activism may pursue additional tactics such as shareholder derivative lawsuits, which are legal proceedings initiated by one or more shareholder against board of directors, management, and or controlling shareholders of the company. The theory behind this type of lawsuits is that the plaintiff shareholder is deemed to be acting on behalf of the company in place of its directors and officers who have failed to adequately act on behalf of the company and its shareholders. In many countries, however, the law restricts shareholders from pursuing legal action through the court system. In some cases, the imposing threshold may be enable only shareholders with interest above a minimum amount to pursue legal action or deny legal action altogether. Hedge funds are among the most predominant shareholder activists compared with most traditional investors, the fee structures of hedge funds often provides a significant stake in the financial success of any activist campaign. Furthermore, unlike regulated investment entities that are typically subject to restrictions on their investments, hedge funds are loosely regulated and can pursue thus greater ranges of activist opportunities. Competition and takeovers metrics that measure a company's success, such as market shares or earnings growth, provides information that is useful for shareholders to judge the performance of a company's management team or board of directors and compare such performance with that of competitors. Senior management risk their employment status in the event of underperformance, and directors in turn can be voted out by stakeholders, that's a funny way to say, shareholders. Traditional views of market and for corporate control is one in which stakeholders or shareholders of a company hire and fire management to achieve better resource utilization. Corporate takeovers can be pursued in several different ways. One mechanism is a proxy contest or proxy fight. In a proxy contest, shareholders are persuaded to vote for a group seeking control position of a company's board of directors. Managerial teams can also be disciplined through a tender offer, which involves shareholders selling their interests directly to the group seeking to gain control. A contest for corporate control may attract arbitros and takeover specialists who facilitate transfers by controls by accumulating long positions from existing shareholders in the target company and later selling the positions to higher bidders. Finally, the hostile takeover is an attempt by one entity to acquire a company without the consent of the company's management. Preservation of the employment status serves as an incentive for board members to managers to focus on shareholders' wealth maximization. This threat of removal, however, can have a negative implication for the company's corporate governance practices if the company chooses to adopt anti-takeover measures such as the staggered board or shareholders' rights plan. To reduce the likelihood of unwanted takeovers, staggering directors' elections can dilute the value of shareholders' voting rights by extending the term that each director serves and eliminating the ability of shareholders to replace the entire board at any given election. Shareholder rights plans enables shareholders to buy additional shares at a discount if another shareholder purchases a certain percentage of the company's shares. These plans are designed to increase the cost to any bidder seeking to take over the company. Non-market factors. This section focuses on criteria, certain non-market factors such as the company's legal environment, and the role of the media, the corporate governance industry, that can have an effect on the stakeholders' relationship and corporate governance. Legal environment. The legal environment in which a company operates can significantly influence the rights and remedies the stakeholders. Countries that have a common law system, such as UK, US, India, and Canada, are generally considered offer superior protection of the interests of shareholders and creditors relative to those that adopt the civil law system, such as France, Germany, Italy, and Japan. The key difference between these two systems is the ability to judge to create laws. The civil law system laws are created primarily through statutes of codes enacted by the legislature. The role of judges is generally limited to rigidly applying the statutes and codes of the specific case brought before the court. In contrast, in common law systems, laws are created both from the statutes enacted by the legislatures and by judges through jurisdictional opinions. In common law systems, shareholders and creditors have the ability to appeal to the judge or rule against management actions and the decisions that they are not expressly forbidden by the statute codes. Whereas a civil law system, this opinion is generally not possible. Regardless of a country's legal system, creditors are generally more successful in seeking remedies in the courts to enforce their rights, and shareholders disputes often involves complex legal theories such as whether a manager or a director breach a duty owed to shareholders. In contrast, disputes involving creditors such as whether the terms of an indenture or other debt contracts has been breached are more straightforward and therefore are more easily determined by the courts. The media. The media can affect corporate governance and influence a stakeholder relationship through the ability to spread information quickly and shape public opinion. As an example, negative media attention can adversely affect the reputation or public perception of a company or its managers and directors. Senior management's concerns over reputation risk can thus reduce the cost of monitoring management activities by stakeholders. Media attention can motivate politicians and regulators to introduce corporate governance reforms or enforce laws that protect stakeholders and society at large. The influence was evident in the aftermath of the 2008-9 financial crisis, when significant media attention was a factor in the adoption of new laws and regulations designed to address perceived deficiencies in corporate governance. Social media has become a more powerful tool as stakeholders have increasingly used to protect their interests and enhance the influence of the corporate matters. Corporate governance has stakeholder management risk and benefit. As illustrated thus far, good corporate governance and stakeholder management can have a meaningful positive effect on a company. A company will likely not meet the expectations of all stakeholders if one group is able to extract private benefit at the expense of another group, depending on their nature and magnitude. Unmanaged conflicts of interest and weak control over a company's operations may expose the company of various risks such as legal, regulatory, reputational, or default risks. By adopting effective guidelines for managing the interests of stakeholders, groups, and institutions instituting adequate levels of control, corporate governance can be reflected in better company relationships, superior levels of efficiency in operations, and improved financial performance. Risk of poor governance and stakeholder management, weaknesses in stakeholder management mechanisms, or in the adoption of poor governance structures can create various risks for a company and its stakeholders. A weak environment can encourage misconduct and hinder the ability of the company to identify and manage risks. Weak control systems in a company with weak control systems or inefficient monitoring tools, such as poor audit procedures or insufficient scrutiny by the board. One stakeholder group may benefit at the expense of the company or other stakeholders. This control consequently have adverse effect on the company's resources, performance, and values. The audit deficiencies at Enron, for instance, prevented the uncovering of the acts of fraud, and accounting records, and other related issues that led to the largest corporate bankruptcies in U.S. history. I'm drinking diluted cranberry juice today. It's quite sour. It's from Costco. Ineffective decision making when quality and quantity of information available to managers and superiors to those available to board and shareholders. In the absence of sufficient monitoring tools, managers have an opportunity to make decisions that benefit themselves relative to the company or shareholder. Without proper scrutiny, such practices might go unnoticed. Deficient decisions can include managing the company with a lower risk profile relative to the shareholders' tolerance, thus avoiding investment opportunities that could create value for a company. Conversely, manager overconfidence may result in poor investment decisions without proper examinations of their effects on a company or on shareholders' wealth. Remuneration policies for management could also have significant implications for a company. Oversized remuneration packages for executives could have an adverse effect on shareholders' wealth, constitute a burden on corporate performance, and affect the interests of other stakeholders such as employees, customers, and creditors. Remuneration policies that are not carefully designed may also encourage managers to seek immediate personal gains by taking excessive risk or focusing on creating short-term performance or stock price increases related to party transactions that underlie unfair terms for the company. And another example of activities that are not aligned with the objective or value creation that can be facilitated by a pro-governance governance system. Legal, regulatory, and reputational risk. Compliance weakness is in implementation of regulatory requirements or lack of proper reporting practices may expose the company to legal, regulatory, or reputational risks. In such case, the company may become subject to investigation by government or regulatory authorities for violation of applicable laws. A company can also be exposed to lawsuits filed by shareholders, employees, creditors, and other parties for breach of contractual agreements or company bylaws for violation of stakeholders' legal rights. In today's markets, information flows rapidly. Improper management, conflicts of interest of governments, failures to bring reputational damages to a company, and its associated costs could be significant. Such risks and particularly acute and publicly listed companies subject to scrutiny by investors, analysts, and other market participants. Default and bankruptcy risk, poor corporate governance, including weak management and creditors' interests, can affect the company's financial positions and may hinder the ability to honor its debt obligations to the extent that the deterioration of corporate performance results in the debt default. The company may be exposed to bankruptcy risks if creditors choose to take legal action. The adverse consequence of corporate failures are not limited to companies' shareholders. They extend to other stakeholders, such as managers and employees, and even societies and environments. Benefits of effective governance and stakeholder management. The development of good governance practices can play a vital role in aligning the interests of managers and board of directors with those of the stakeholders. While balancing the interests of the company's stakeholders, a good governance structure can be reflected in operational efficiency, improved control processes, better financial performance, and lower levels of risk. Analyst considerations in corporate governance and stakeholder management. In the past, analysts may have considered corporate governance and stakeholder management issues as only peripherally related to traditional financial analysis. Generally, these issues were seen as obscure and likely to be material drivers of performance. Following the aforementioned governance failures of the early 2000s, the global financial crisis, and rise of shareholders' activism around the world, there is a little doubt that governance and stakeholder issues have been increasingly important topics for analysts. Some key questions the analyst must consider when assessing a company's corporate governance or stakeholder management systems are as follows: the company's ownership and voting structure among shareholders. Well, who represents shareholders on the company's board? What are the main drivers of the management team's remuneration and incentive structure? Who are significant investors in the company? How robust are the shareholders' rights at the company, including relative to peers? How effectively is the company managing long-term risk, such as securing access to necessary resources, managing human capital, exhibiting integrity and leadership, and strengthening the long-term sustainability of the enterprise? Qualitative analysis of the issues typically provided by a company's proxy statement, annual reports, and sustainability reports, if available, can provide important insight about the quality of management and sources of potential risk. Economic ownership and voting control. Generally speaking, corporations with publicly traded equities have a voting structure that involves the vote of each structure, that is, the shareholders' voting power is equal to the percentage of a company's outstanding shares by the shareholders. Board of director representation, investing in the company. ESG considerations for investors. The inclusion of government factors in investment analysis has evolved considerably. Management and accountability structures are relatively transparent, and information regarding them is widely available. Also, the risk of poor corporate governance has long been understood by analysts and shareholders. In contrast, the practice of considering environmental and social factors, which collectively with governance forms the commonly used acronym ESG, has evolved more slowly. A large number of environmental and social issues exist. Identifying which factors are likely to affect the company performance is not an easy task. Issues driving the inclusion of environmental and social information in the investment process includes scarcity of natural resources, climate change, global economic and demographic change, the societal evolution. Although ESG factors were once regarded intangible or qualitative information, refined in the identification of analysis of such factors, as well as increased corporate disclosures, have resulted in increasingly qualifiable information. Still, the process of reflecting qualitative ESG related information and data in financial valuation is evolving. The chapter summary. The investment community has increasingly recognized the importance of corporate governance as well as environmental and social considerations, although practices and concerning corporate governance and ESG overall will undoubtedly continue to evolve. Investment analysts who have a good understanding of these concerns can better appreciate the implication of ESG consideration in an investment decision making. The core concepts covered in this reading are as follows. Corporate governance can be defined as a system of control and procedures by which individual companies are measured. There are many systems of corporate governance. Most reflect the influence of either shareholder theory or stakeholder theory, or both. Current trends, however, point to increasing convergence. A corporation governance systems is influenced by several stakeholder groups, and the interests of the group often diverge or conflict. The primary stakeholder group of a corporation consists of shareholders, creditors, managers, and employees. The board of directors, customers, suppliers, and government regulators. A principal agent relationship or agency relationship entails a principal hiring an agent to perform a particular task or service. In the corporate structure, such relationship often leads to conflicts among various stakeholders. Stakeholder management involves identifying, prioritizing, and understanding the interests of stakeholder groups, and on the basis managing the company's relationship with stakeholders. The framework for corporate governance and stakeholder management reflects a legal, contractual, organizational, and governmental infrastructure. Mechanisms of stakeholder management may include general meetings, a board of directors, and audit function, company reporting and transparency, related party transactions, remuneration policies, and other mechanisms to manage the company's relationship with its creditors, employees, customers, suppliers, and regulators. A board of directors is the central pillar of the governance structure, serves as the link between shareholders and managers, and act as the shareholders' internal monitoring tool within the company. The structure and composition of a board of directors vary across countries and companies. The number of directors may vary, and the board typically includes a mix of expertise level, backgrounds, and competencies. Executive internal directors are employees by the company that are typically members of senior management. Non-executive external directors have limited involvement in daily operations but serve an important oversight role. Two primary duties of board directors are duties of care and duties of loyalty. A company's board of directors typically has several committees that are responsible for specific functions and report on the board. Although the types of committees may vary across organizations, the most common are audit committee, governance committee, remuneration or compensation committee, nomination committee, risk committee, and investment committee. Stakeholder relationships and corporate governance are continually shaped and influenced by the variety of markets and non-market factors. Shareholder engagement by companies can provide benefits that include building support against short-term active investors, countering negative recommendations from proxy advisory firms, and receiving greater support from management's positions. Shareholder activism encompasses a range of strategies that may be used by shareholders when seeking to compel a company to act in a desired manner. For a corporation's perspective, risk of poor governance includes a weak control system, ineffective decision-making, the legal, regulatory, reputational, and default risk. Benefits include better operational efficiency, controls, and operating and financial performance, as well as lower default risk or cost of debt. Key analyst consideration in corporate governance and stakeholder management includes economic ownership and voting controls, board of directors representation, remuneration and company performance, investor composition, strengths and shareholders' rights, and the management of long-term risk. Several terms, somewhat interchangeable, and investment approaches have evolved in relation to ESG, sustainable investing, responsible investing, ESG investing, and socially responsible investing. Negative screening is an approach to ESG implementation that excludes certain companies or sectors from investment consideration because of their underlying business activities or other environmental or social concerns. Positive screening is best in class strategies focused on investments with favorable ESG aspects. Thematic investing focuses on investing in companies within a specific sector or industry theme, such as energy efficiency and climate change. Impact investing seeks to achieve targeted social or environmental objectives along with measurable financial returns. ESG integration or ESG incorporation integrates qualitative and quantitative environmental social governance factor into traditionally securities and industrial analysis. Okay, so this is reading 33. This concludes reading 33. We'll get into reading 34 in our next reading. So I do hope my readings have been helpful, and I hope to see you guys in the next reading. Goodbye.